Scope Advisors. Is this turned on? Okay. So before I have introductions from each of the panelists, I'd like to put up the opening poll question and give everyone a chance to pull up the app and answer. It's a question that I think is really relevant to the discussion that we're having today about the balance between financial returns and financial sustainability and social impact. So if everyone just takes a moment, I'll start off. If you want to introduce yourself and give a few words about your background.
Sure. Thank you, Blake. Hi, good afternoon, everyone. So these are the diehards. We're staying to the end. Good for you. So very quickly, I'm Margie from Thoughts in Gear, and we are an ESG and a CSR consulting company. And we are jazzed about moving capital markets towards making responsible decisions and, more importantly, taking very responsible actions along the way. We're practitioners on the ground, so you hear me speak a lot about taking action and making a move and really making it happen out there. We're happy to be working across the value chain, so we work with PE firms to quantify their social ROIs of their portfolio companies. We work with regulators to conduct ESG training, and we work with, more importantly, companies to help them down the ESG journey as well, in terms of understanding, in terms of taking action as well. We'll talk more about that. Thank you.
Thank you.
Hi, my name is Ming Wong. I'm the co-founder and CEO of Asia Community Ventures. We are based in Hong Kong, a registered charity. We work primarily with governments, family offices, and foundations to promote impact investing as a tool to address social and environmental issues. We have two major areas of practice. The first one is policy research, because we believe that all governments have a very critical role to play in terms of building an ecosystem and setting the right environment regulations to encourage more players into the market. In the second area, we work with social startups, founders and entrepreneurs that are looking to build social businesses that can scale. In particular, we focus on tech-related companies in the areas of education, environment, and healthcare.
Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Umar Munshi. I am involved in Islamic crowdfunding in two platforms. So I founded ethiscrowd.com, which you can see on my shirt. What we do in Ethis Crowd is we do social impact real estate development funding. So most of our activities initially and our projects are in Indonesia, and right now we are starting to grow quite rapidly in Malaysia also. We focus on affordable housing as well as wakaf. So that's the first platform. And the second platform that I co-founded is called Kapital Boost, which focuses on social SMEs with a social motive. Right, thank you.
Thank you.
Hi, my name is Mohammad Raafi. I basically am focused on social fintech. Over the past couple of years, we've been developing three platforms mainly. One is focused on a online crowdfunding platform focused on revenue sharing for handmade producers around the world. We're also working on a humanitarian finance platform currently. And the platform we're just about to launch in about a week or two is a Islamic microfinance crowdfunding platform built on a very similar concept to Kiva with a few changes, mainly around the concept of micro-waqf. So we work with various partners from around the world, including Kiva, including high net worth individuals from the Gulf, as well as multilaterals.
It's great to have a panel. Can we get the answer to the poll question? So should social impact investors target a market rate of return, or should they look to social impact as another, can we keep it up, please? With the answers, please. So it seems like there's some question about the balance between financial returns and social impact, which I think from across the spectrum in impact investing and ESG and in crowdfunding, there's a balance around the concept of social businesses, of how social they should be and how much they should focus on their underlying business. This has been a factor that's limited some of the growth in impact investing. So Ming, would you like to start off with and discuss some of the challenges around the growth of impact investing in social businesses?
Well, I think for me, the biggest challenge is perhaps the lack of understanding of what impact investing actually is. And once it is clear in your mind what it is you're trying to achieve with impact investing, then you can actually go about doing it as opposed to just sitting around waiting for opportunities to come to you, right? For instance, if your starting position is you're running a foundation that is hoping to solve very specific social and environmental issues, let's pick clean air as an example, right? Then you have at your disposal funds to either give to other charitable organizations to go around doing the work, or if you're more open-minded and far-sighted, you could actually invest some of these funds into startups that are coming up with solar technology or other types of non-fossil fuel-related technology. You can invest in them, right? The bottom line is the same. If they're successful, then you would have achieved your goal of creating cleaner air for everyone, right? And the actual vehicle of doing it is not relevant. Where there is confusion, as evidenced by the question you posed before, is people who are unclear what their starting position is. In other words, if your primary goal is to make money, then, but when you see renewable energy resources as an avenue to make money, then obviously you will view impact investing as somewhat suboptimal in the sense that you may not be able to maximize your profit. On the other hand, if you're coming from the role of a foundation, you just want maximization of impact, and you don't mind donating money year in, year out, then you may be somewhat suspicious of entities that are created to make money, right? Particularly if you're coming from a government-related entity, you somehow feel that any public money should not be invested in activities that allow other people to make money. You somewhat forgotten what it is. So that's what I say. Rather than frame the question as, is impact investing been limited, I would encourage people to think about what is it that you're really trying to do here. Once you can clarify that in your mind, then the path towards achieving what it is that you want to do becomes very clear.
Margie, would you like to share the perspective from the business side? How do businesses, larger businesses in particular, view startups and view impact investing in social businesses?
No, absolutely. Thank you. I think there are a couple of, we might have shared this earlier, there are a couple of aspects that we want to look at. I think first and foremost, the whole concept of social business. And, I challenge anyone here to name a business that's not social. So, I come from a perspective that businesses are businesses. Maybe they should be labeled socially positive businesses and socially negative businesses, but every business is social. In some form or manner, you will affect society. And I think businesses need to understand that and begin to accept the fact that if they run a business, they will impact society. And then they quantify if it's positive or negative, and that needs to sit well with businesses. I think that's the first angle that we would look at. I think the second angle is, to Ming Wong's point, is if we, and I challenge everyone here to start thinking beyond equalizing returns from impact investing, beyond cost cutting, beyond being able to justify social businesses almost and look at it as almost a competitive strategy. You know, I'm picking up a lot of concepts, obviously, from Michael Porter and repeating them here, but really, if we look at the next growth engine as society and the social sector, I'll give you an example. So if we look at the population of the world, we took 123 years to get from 1 billion people to 2 billion people. We took 12 years to get from 6 billion to 7 billion. If you're focusing on inclusive finance, you're going to grow exponentially just as your market has. So I think it's maybe about, from a business perspective, it's very much about viewing it, not viewing them as beneficiaries, but as consumers. And very much about leveraging what it is that we can bring from a social impact perspective that will both help our bottom line, but also contribute to society positively. Thank you.
I think talking about the large base of consumers, I think is a really good transition into the crowdfunding, and how do consumers that look to finance businesses with social impact, how do they perceive the social enterprise opportunity? Raafi, if you want to speak on some of your experiences.
Sure. So from a socio-economic impact perspective, you get three types of consumers, three types of investors. The first type is those investors who really, really care about social impact and not so much about return. The second type is those who equally care about social impact as well as return. And the third and final type is those who mainly care about return, but also would like to see, some impact if possible. And what I strongly feel is that you need all three. You really, really need all three categories for a number of reasons. So if you go back to the first category, you certainly need consumers and investors and impact-minded people to be able, who don't care about return, to be able to create innovation at the bottom of the pyramid. Without their investment of time, energy, and capital, you won't be able to create proof of concepts where more institutional investors will not go into. So being able to use that sort of capital that has a higher risk appetite, is more patient, you're able to then create innovation on the ground, which then gets you to the third category, who will then come in and theoretically boost that and scale that opportunity. Now, at the same time, you need a second category as well. You need people who will not sell out for return, or will not sell out for impact for return. So you need people who both validate that impact is important and return is important. And this is the most important group, right? The group that continuously champions innovation for return while not selling out on the impact that each intended product creates. Now, what's really interesting now is that how do we then scale the crowdfunding initiatives that are ongoing and the other innovations that are happening on the ground in places like Kenya, in West Africa, in Eastern Europe? Well, you definitely need institutional investors and multilaterals and larger banks to come in and scale these initiatives. Now, there are, especially when it comes to our field, which is microfinance, now there's two places where this can easily happen, and it requires innovation, and it requires capital from the initial two categories, which is kind of lowering cost of the deployment of capital, as well as understanding creditworthiness. So there's opportunities for innovations to happen that are both profitable for those disruptors, which will make it easier for institutional investors to come in and invest in. But what we really need is we need tiered companies and tiered development actors who come in at all three categories, provide solutions that each complement each other and that each resonate with all three investor bases.
Yeah, and so bridging the gap between the types of investors and what their appetite. Umar, your business has been involved in sort of that bridge of using retail consumer crowdfunding as a bridge for social impact projects to get them from conception to a stage where larger investors are interested in them. Could you discuss where you fit in that?
Yes, right. I think it's very important also, before I get to your question, for investors or the entire ecosystem, the investors, the platforms, the banks, the financial institutions, the donors, for everybody to understand that what we have come to realize, which is that in the new economy, or in this new world economy, where a lot of communities and a lot of retail investors especially exist online, social impact or the stories that come with social impact investment can create a lot of intangible benefit for everybody. Right? Intangible can be in terms of goodwill of the brand. It can be in terms of lower marketing costs through virality of these stories, which spread very quickly online. There are many, many nuances to the benefits of going social when it comes to promoting or spreading social investments, right? And I think that's something that needs to be explored further and to be understood at a deeper level. Even for myself, we are still learning all these things. When it comes to the different investors and how they can fit together or complement each other, what we have come to realize is that when we work with the crowd, I guess the crowd that gets to us or the crowd that comes on board on our initiatives, more of what you mentioned earlier, people at the normal, the mid-level of society who have some extra cash, who want to make returns as well as they want to get some or provide some social benefit or some impact with their money. So now these people are willing to come in with small amounts of money and take the risk, right? So there is the source of risk capital. And what we have done is that we have brought the banks in Indonesia, the Islamic banks in Indonesia involved, where the crowd makes our projects bankable or fulfills the criteria of the banks, and then the banks can come in. So that creates a good synergy between the two, because the original crowd investors now have the backing of the banks at a later stage. And usually we can pre-arrange or pre-prepare all these things. Right? So there are numerous ways to create synergy or to close gaps that are sometimes very obvious, but nobody is servicing these gaps. And when we go using technology, we can actually service more gaps because we have tremendous savings and smoother processes in many ways. Yeah.
And I think one of the key things to remember with impact investing is that as a concept, it's only been around for less than 10 years since the term was coined by, I think the Rockefeller Foundation had a conference where it was coined in 2007. And so finding ways to accelerate the growth from around 20 billion, I think today with the Eurosif estimate from 2013, how do we accelerate it? What's the role of government? What's the role of participants within the marketplace together, working together to accelerate the growth? You want to?
I think those of us who are familiar with impact investing usually look to the UK as a leader in terms of the role of the government in terms of promoting the space, right? There are many, many ways, and I think in the last 5 years, a lot of other countries actually have introduced their own initiatives. The term, we talk about impact investing, but the reality is that it is a very, very broad space that overlaps into SRI and CSR. I'm probably saying things that most of you know already, right? The UK introduced the concept of social impact bonds, right? And I understand there was a social impact bond, Islamic bond in Malaysia last year. So that's great news. But the reality is that the impact of those instruments are actually fairly limited compared to, say, the potential impact of crowdfunding. Now, I'm talking about crowdfunding to promote social enterprises and social businesses here, as opposed to crowdfunding for regular companies, right? We're not talking about how do we raise money for a dating website, right? There are lots of people willing to do that, right? You can argue there's a different type of social impact being created, but that's presumably not what we are referring to here, right? Governments can, the UK has also introduced tax relief for investors who invest in bona fide social enterprises, right? So that begs the question, what exactly is a social enterprise, right? And in many jurisdictions, it is not well defined, right? Common law jurisdictions like Hong Kong, Singapore, and Malaysia, you either are a company limited by guarantee or company limited by shares. So there's nothing in between yet. So one way the government can actually promote the space is to create entities that fit that criteria. So once the legislation is clear, then whether it's funders or investors can see clearly that hey, these guys are real. Right? I'm not just going to invest in a company and next day they disappear with the money because unfortunately we found ourselves in a scam, right? So that's one of the biggest risks of crowdfunding, by the way, right? I do want to respond one point that you raised earlier because maybe I misheard you, but I don't think it is the role of the crowd to de-risk an investment for banks. I think, but it's potentially the role of large foundations and governments, people who are normally put money to work to address a social issue anyway. They could then de-risk a project to bring in commercial investors, whether it is bank or private investors. I would actually prefer that governments and large foundations step up, de-risk a project before opening it to the crowd, rather than relying on the crowd to bear the first risk. Because the risk of that, of losing all your money, is the greatest, right? So that's what I would like to hear your response, right? What, in the crowdfunding initiatives that you do, how do you ensure that the crowdfunders are just not basically giving the money away?
Yeah. Please respond.
Yes, thank you for that point. Something that's really very valid and very important for everyone to consider also. Now, in any form of crowdfunding project or campaign, there's investment based. There is always that risk of losing your capital. What I was trying to say is that I can actually reduce this capital by bringing in the financial institutions at a later stage, as opposed to not having that source of funding coming in or that backing coming in at all. You get what I mean? The status quo for typical crowdfunding is that there is that risk. It is inherent, it is real, and it is always going to be present when you invest in the real economy, especially SMEs or startups. What I'm trying to say, I'll just repeat again to make it clear, is that we can actually get other parties involved to reduce that risk. So like for us, what we do is we have already gotten the in-principle approval or the agreement or the cooperation of the bank to come in at that stage. And to reach that stage, we need to crowdfund this amount of money. So that's what I mean. It's not, in a sense, to de-risk it for them, but when we come in, we can actually create a scenario where they are able to come in. The issue is, in theory, it'll be great if the governments and the institutions can come in to de-risk it before people start getting involved. But the reality is it's not necessarily happening fast enough or enough at all in that sense. So the way I see it is that the people need to lead the way. The people need to put their money where they want to see change, and then we, in a sense, force or push or induce and attract the other parties to come on board.
Yeah, I think that in terms of the issues of who's bearing the risk, Raafi, I mean, you're raising crowdfunding for Islamic microfinance projects. How does the balance of the risks between larger institutions and retail crowdfunding, how is that balanced and how is that addressed?
Well, the fact is that the balance is just starting to be addressed. And the key aspect to any investment decision that anyone makes, whether it's a large institutional investor or it's an individual person from the crowd, is that they need to have data to make a data-driven decision. And what's sorely lacking in the microfinance space, as well as in many other spaces, is the right data, and the right data being mined in the proper way to be able to generate, usable insights from that data. And just to give an example, if you look at the 22 Arab League countries in the Middle East and North Africa, not a single country has a credit bureau. Many of the countries have a blacklist on who not to give to, but you won't really find a robust credit bureau that actually tells you the credit score of an individual. And what's really interesting about the whole credit domain, just since we're in this topic, is that even in America, the credit scoring system is pretty obsolete given the amount of data that we have today. And what's really fabulous is that if you look at a country like Kenya, but if you look at a country like Somalia, Sudan, and very, very soon you'll get countries like Morocco and Tunisia, where you have a lot of mobile data available to you from both a payment perspective. There is a huge opportunity to gather this data from telcos and be able to mine this data to make investment decisions. On top of that, there are now there's instruments to also kind of replicate what a loan officer would do on the field to gather data from that too. So for example, one of the things that we did is we rolled out this psychometric analysis on potential borrowers of microfinance. And this psychometric, this test was created by Dr. Asim Khwaja from Harvard University, and he was able to test it in around 1 million borrowers from around the world, mainly Southern Africa, East Asia, as well as South America. And what it showed is that just a simple psychometric analysis that we started delivering through just mobile phones through a text message. This psychometric analysis was able to prove or to basically to decipher default rates 60% better than the ways that were previously done in these countries. And that's phenomenal, right? So now you don't need a loan officer. You can just roll out the psychometric test, which basically covers 4 areas, right? It tests a person's emotional intelligence, their contextualized business skills for the locality, and their integrity and how they view the world. Now, imagine if you had this data on a person, and you also had their mobile activity data. What sort of payments are they making, how active they are, how volatile is their lifestyle. Now, all of a sudden, you have the entire picture of a person, and you can make a very, very data-driven investment decision on investing in this person. Now, because of the data, you don't even need to necessarily make a debt-based investment decision. You can make an equity-based decision. You can do some sort of revenue share with that person's business. A lot of opportunities open up, and that's when you get quality investors coming in, both who have risk appetite to make probably an equity-based investment decision, or who have a more immediate need that they can go into a debt-based product.
Great. And when you have companies, Margie, when you have large companies that are looking at the social impact that they're making and looking at social businesses as a way to make a financial return, but also support positive financial social impact, how do they come in a way that best supports the other parts of the ecosystem and can work with some of the policies that are being rolled out by governments to help accelerate the positive social impact area of finance?
I think that's a fantastic question. So I think that ties very nicely as well into your previous question on how do we grow impact investing. And a lot of times, in terms of growing impact investing as a whole, we obviously need all the players to play a part. So the private sector has, your question is on the private sector, what role do they play? So obviously we know that huge funds, resources sit within the private sector. We need to create the will within the private sector to actually move the needle and leverage the private sector, but that also puts into play the government's support that are needed, even the regulators and the social sector, to actually be able to come together and quantify what is impact investing and how do we grow it. So to answer your previous question on how do we grow impact investing, I think there are 3 very clear things that need to happen within the impact investing market before it can actually make mainstream. And mainstream is a very regulated language that we all speak. So a lot of times I think we need to almost drag it to the mainstream. So the first thing is innovation. And I think, with the previous very fascinating panel on crowdfunding, when disruption and innovation become mainstream, when it becomes something so common to us, when we ride in an Uber car and we don't think of how strange that is, I think a lot of times that innovation almost needs to come center field first. So in innovation, I'll give you an example. So for example, not many private institutions have analyzed their data, and that's going to be my second point, data, to actually see that it's actually cheaper to support a problem student within their private college than it is to have a dropout due to loss of tuition, for example. So it's finding those instances. Is GE investing in portable medical devices to penetrate rural India? It's finding these profitable and yet socially positive examples of innovation that can actually take hold of the market. The second point, which was made by a fellow panelist, is data. So data is going to drive the market, and we know data is so much more available right now. The analysis of the data is yet to come, but that will also drive the market. The third very, very important point that my team members and I strongly support is epic execution. So a lot of times in these businesses come with fantastic social purpose, great financial business model. We need to start realizing some of it with just hardcore, persistent, strong execution. And then obviously, that's something that we need to case study, that's something that the media needs to talk about, that's something that we need to bring into mainstream conversation.
Great, and I think if we have time for questions, I have one more question for Ming about when we're talking about measuring impact, what policies are most beneficial for supporting a consistent impact measurement so that when we're looking at how beneficial social businesses, social activities are, that we know that we're getting something real and not something that's sort of a glossy brochure with not much behind it.
I think that's going to need probably an entire new seminar to talk about impact measurement. My view on impact measurement is probably not necessarily reflective of the broader industry view. When I invest in a company or when I work with a group of founders, the first question I ask is, what social problem are you trying to solve? Right? And if they are not able to articulate to me, within 1 or 2 minutes, then that's it, right? But if they are able to do that, then I would want the founders to spend all their time growing their business and building, scale. Because if they succeed in doing that, the impact is self-evident, it's already built into the mission, right? But the day when I have to start getting them to report to me how many poor people they've served, how has the poor people's lives been improved and so on and so forth, it's a huge burden on the company to have to report all that. But social impact, unfortunately, is something that large grant-making organizations ask for because it's what they're paid to do. And if you're spending public money, you have to ask for that, right? I would rather be able to assess impact using data that esteemed colleague here talked about earlier. In other words, the company is not burdened to have to create all this, hire new people to do all this numbers crunching for you, but it's already built into that, right? If you're doing crowdfunding as part of inclusive finance, or how do you improve credit scores, how do you assess credit viability, the better you do your job in terms of doing that, the more likely your business is going to prosper, right? So you're not doing it just to make someone happy that you're reporting it. It's built into your system. So I think the conversation has to pivot to impact measurement, to how do you actually use data, better. And that part of the data, the impact is already built in. In other words, you don't have to go out of your way to try to report numbers just to make some pencil pusher happy, because that person has given you a grant and therefore believes that they own you for the next few years. So I'm sorry. I'm sure others may have a different view, but that's how I would look at it.
Does anyone else want to comment on this issue of impact measurement?
Sure. I think one of the important things of impact measurement is really analyzing why it is that we do what we do. So it also, I agree with you, it depends on source of funds. So a lot of times it depends on source of funds to actually distinguish one form of reporting from another. But at the end of the day, I think we need to understand that what gets measured gets done, and what gets measured gets understood. And the more it's understood and the more it's done, the more the measurement will be much more effective, not just in reporting what you do, but in governing everything that you do. So I think if we think of reporting less as a compliance activity and more as almost an internal improvement activity as well, it serves its purpose. So, back to your source of funds. So corporations love reports because that's how they govern. That's part of the corporate governance. That's what they have to do. That's what they have to report to boards on. If you can come to the same page where that report actually helps them speak to their boards, but helps you run your programs, so that's a first win, if you will, a mutual win. If your source of funds is, for example, a foundation, they will be much more interested in the social impact, which is no less easy or no less hard, because quantifying that social impact is also a discussion you need to have up front. What do they see as success? If you achieve 10,000 beneficiaries, is that something that they would view as success? Or do they want 100 beneficiaries with much deeper understanding of the impact? So I think it's really important, the conversation up front, that will drive that whole monitoring and evaluation process towards something that works not just for your funders or for your investors, more importantly, but for yourselves as well.
I think each of you looked like you wanted to contribute, add something to that.
Right. In terms of the impact, I think this is something that's very, very interesting, because usually people try, or usually the preferred or natural method is to try to quantify something that's very qualitative with key metrics, with certain milestones and benchmarks and figures. What we have started doing that also in terms of number of houses that our crowdfunding has contributed towards building, right? And at this stage is about 5,000 houses. But to really capture the impact or the essence of all these different social activities, we need to find a way to go deeper and look at it at a more long-term perspective. For example, 5,000 houses is good, right? Everybody can relate to, oh, 5,000 houses or 5,000 families. But we have to go to the next step, where you have 25,000 people in these 5,000 houses. And the next step is that when these low-income families have these houses, it's an opportunity, or it can actually trigger a break away from the poverty cycle, right? So then there's that impact on the next generation. There's an impact on education. There's an impact on women. There's so many other impacts that follow up after that. And the challenge is to capture all of these impacts and measure this impact and present it to the public so that they understand that how far that dollar has gone, not just in terms of the financial benefit, but the social impact in the long term. Yeah, that's my contribution.
Raafi?
Yep. And sometimes when you end up doing this qualitative impact measurement, you find that impact isn't being made. And I wanted to kind of bring an example from Somalia. The Somalian diaspora is very well known for sending remittances back to Somalia. It's one of the the largest sources of the Somalian GDP. And if you look at it from a GDP per capita basis, very few countries do it better than the Somalian diaspora in terms of sending money back home. Now, what's interesting is that recently there's been a lot of frustration amongst the diaspora abroad that the money that they're sending back home is not reaching the impact that it should. So what happened is that there was a huge remittance company in Somalia that had branches in all over the country. And one way that a number of organizations, including our own, that came in is that we're like, why not convert this remittance company, or not convert, but why not also bring a microfinance arm to this remittance company, because they already have the brick and mortar stores all across the country, and they're sitting on a wealth of remittance data for every individual that comes to collect their remittance. And what happened is that this was a resounding success. And an example of how we were able to figure out it was a success is that if you look at Kiva, which is one of the largest crowdfunding platforms, they're just about reaching $1 billion in total raise from the crowd. Their lowest performing region in terms of their portfolio is the Middle East and North Africa. And amongst that, until just a few years ago, Somalia was one of their worst performing countries. Now, after the conversion of this remittance company into a microfinance institution, the response from the Somalian diaspora abroad was so great that the number 2 most prolific MFI amongst the 1,000 MFI partners that Kiva has around the world is a Somalian MFI. And what does that mean? What does being the number 2 most popular MFI on Kiva mean? It means that every time a client wants to raise funds on the Kiva platform, within 16 hours, that appeal is fulfilled, which is just absolutely phenomenal. So every time an MFI posts an appeal, less than a day it takes for the Somalian diaspora and others to fulfill that, which is phenomenal, right? So really, it's just finding where that impact is collected, where that data resides, and then understanding the needs from abroad, and then making that connection happen.
Yeah.
Just to add to that, yesterday we were asked a very interesting question. We were asked by Umar during one of the panel sessions, if we would invest in if all things were equal, would we invest in a more socially responsible company? And I think that's a question that begs an of course, right? So there's definitely not a no to that question. But I think the most important part of that question was all things being equal. And I think that's one of the things about bringing social business to the mainstream as well, is that we can't use the word social almost as a crutch, if you will. I apologize if I'm offending any social entrepreneurs, but we can't use it as a crutch to say there's going to be a trade-off, and we're not going to make. And there are organizations that will sign up for reduced financial returns for social impact, which is fantastic. But if we're going to go mainstream, we're going to have to strive towards the all things being equal. And I think that's where we have to very clearly determine that there is a role for every type of institution. So there's nonprofits and there's business. And I think, for nonprofits to become much more enterprising is fantastic, but they will stick to their mandate of being a nonprofit. For social businesses, again, they need to strive for the all things being equal. Of course, as an investor, you would invest in something more socially responsible.
Thank you. Do we have time for a few questions? Yeah. You just push the button next to the microphone. Yeah.
Okay. Thank you very much. Congratulations, panel. Interesting session. I saw a question. It's an invite. So I'll just start off. 40 to 60% of all palm oil produced in the world is produced by smallholders. And therein lies the biggest opportunity to solve a lot of the world's problems in terms of deforestation and poverty, alleviation, etc., etc. My organization has tried to reach out to these smallholders. A difficult, big stumbling block for smallholders, despite the fact that it is a viable activity, they can't get access to financing, which then causes them to buy poor planting material, which then destroys their ability to earn a decent income for 25 years because they're stuck with bad planting material. So it's an invitation if any one of you are interested, because I've talked a lot about this. I think the traditional financial institutions cannot fill this gap, and I'm wondering if one of you on stage or one of you in the crowds are thinking of wanting to venture into this. Let me know.
Do we have any other questions?
Maybe just a quick response to that. And I think it's amazing how far RSPO has come. So congratulations. I think when the mere news that one of the companies are going to be suspended from membership from RSPO actually affects their stock price is a great step in the right direction of bringing that conversation mainstream.
There's a question over there. Please go ahead.
Yes, I would like to ask about the reporting that was discussed related to the socially responsible organizations. So recently, Kickstarter announced that they want to introduce a category of corporation called the B Corporation. So they will actually make it incumbent upon themselves to report social impact, I think, on a biannual basis. So some I can see on the panel were pro incorporating this kind of rule, and some against. So I'd just like to ask, what do you think the impact on responsible finance would be if more corporations started to take a shift towards changing the structure towards something like this B status corporation, where they make social impact something that they actually have to report and they have to achieve on a yearly basis? Thank you.
What you're referring to is a uniquely American, invention. The Benefit Corporation is probably approved in, I don't know, probably 15 states in the U.S. at this time. I could be off by the number. The big difference is that if you reincorporate as a benefit corporation, then your shareholders, it's understood that as directors of the company, you cannot be sued by shareholders if you are choosing to make a decision that is not necessarily maximizing your financial benefit to the company, right? So that's one of the arguments for turning yourself into a benefit corporation. B Corp itself is a certification by B Lab, which is you can be a B Lab certified company anywhere in the world. You don't have to be American registered, right? So that's the difference. I think it's a fantastic development. It's one way of addressing, of signaling to the public or your stakeholders what you stand for, what your company stands for, right? Typically, if you go through the process of certifying yourself as a B Corp, then it means that you care about more than just financial returns. You care about the totality of social, environmental, financial, and governance.
For me, I feel that this is something incredibly important that needs to eventually become the status quo. Of course, that's a long way from where we are right now. But if world leaders, the governments, and the regulatory entities come in to make this a requirement and to make this something that the corporations and the businesses have to consider and have to report, then definitely there will be a significant impact. The issue is more of how do we get to that stage where this is something that is seen to be necessary, right? We all know global warming, for example, it's past the tipping point, but still, we are not taking action on it. So the issue is not when should we do it. We should have done this a long, long time ago. To me, is how do we come to a situation where, or a scenario where it has to be done, or the powers that be need to do it in response to maybe, probably, the way I see it is from the community or from the public or from society. I believe in from the bottom up, we have to push and we have to pressure our leaders to come to a realization that this is what we need and what we want, not for ourselves, but for the bigger picture and for the world in general. So for me, the impact will definitely be great. The question now is how do we reach that stage where this becomes a must?
Before you respond, can we put up the final poll question to allow people a chance to answer? While Margie, go ahead with your point.
No, I think that's a great question on reporting. So just as in terms of the stick and the carrot, I guess. So Bursa Malaysia, or the KL Stock Exchange, has regulated sustainability reporting for companies in a staggered approach. So everyone above 2 billion in market cap will have listing requirements in 2017 to actually produce a sustainability report. So we're definitely heading in the right direction. There's also, I think it's been mentioned a couple of times during this summit, the ESG index in Malaysia, of which now there are 34 out of the 200 evaluated companies, of which, by the way, 70% are Sharia compliant, that are already on the index. So what's interesting about that is that FTSE only reviews publicly available information. So it's not about having the policies, it's not about having the right processes in place, it's about disclosing as well. So that, as we know in our Asian market, sometimes is a little bit of also a difficult hurdle to overcome. But that's definitely, again, another step in the right direction, I think, in terms of reporting and regulation.
Great. Thank you. Can we have the response to the poll question up as we close the session? Well, I think, yeah, all of the above approach wins the day, and delivering social impact seems to also be a particular focus for our audience. So, Paul, would you like to come up and conclude the day before we go to lunch?
Indeed. Thank you all so much for attending the inaugural 2016 Responsible Finance Summit. A couple of concluding remarks. You know, we started today off with His Royal Highness the Emir of Kano, who, if you all don't know, has sort of an incredible story behind him. He left his position as the head of the Central Bank of Nigeria after exposing a massive fraud at the state-owned oil company. Now, there are many parallels with what he was speaking about this morning, and places all around the world, including here in Asia. And I think the most important message from his talk, which is sort of reverberated throughout today, and maybe throughout both days of this summit, is take the political risk of changing the paradigm. And all of you who are involved in responsible finance are in some way taking that risk. And that is quite important. He also pointed out that finance doesn't take place in a vacuum. It affects all of society. And our panels have sort of affirmed that and entered the nitty-gritty, the details of how to implement that new paradigm. Things that have come up over and over again, changing the mindset by speaking to people, being bold, and taking that risk. Part of that mindset often involved long-term investments instead of very short-term returns. That's come up over and over again. Also, advancing regulations and a more proactive stance by regulators to incorporate new technologies and to mandate better reporting and find ways to use data in a more effective fashion. We've also touched again and again on how to account for externalities like environmental factors and climate change. Those are just some of the points that have been covered, but I think that overall this has been a highly productive summit, and I'd like to thank you all for coming. We can all go to lunch. Thank you.